Welcome to our weekly forecast. My name is Jay Norris, a trading instructor at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. First market we're going to take a look at will be the Australian US dollar. We've been bullish on the Aussie overall. We think that you've got a shot at 96 even. In fact, if you eclipse 96 even, potentially you see 98.5, 99, that region, the top of our sell zone up there. Essentially, we're looking at that this move that began in late January of this year is still intact. This bull run, this bull move, it's marked by higher lows along the way. It's still intact, and we think there's in all likelihood that again you'll see 96 even and potentially beyond that overall. So Aussie dollar, we're still in the buy the dip camp. Next market, the dollar Swiss. Dollar Swiss continues to correct lower. We talked about this last week, how as short-term traders we are clear to be selling rallies in there, and that was that proved timely, because that's been the case. As a short-term trader, you would have been making your money on the short side here in the dollar Swiss. Great lessons too as far as understanding the different dimensions in time in trading. This pattern we're looking at, the daily chart from that low to that high and then the retracement, that's bullish. You've retraced, well, you're right at a 50% retracement. You've retraced less than 5/8 of the move. So, as long as you haven't retraced 5/8, as long as you haven't retraced 5/8 or up to 2/3 of that move, then this pattern is still bullish. So long term is bullish. On the other hand, as we talked about the different dimensions in time, shift down to a 5-hour chart, and what was a bullish pattern on the daily chart here becomes now obviously a bearish pattern on that 4-hour chart. So if you want to make money in that type of environment, you have to heed what's happening, and now you're selling rallies on the lower time frames. Here I'll show you the zone created. You take that high to that low, and you can see that zone created between the lines there. You're going to be selling rallies, and since you had that shift, you could see selling rallies was a good way to go, because you have a succession of lower highs on the way down. So as a short-term trader, we're focusing on that, and that's what we were talking about last week when we showed you that these short-term patterns had in fact shifted lower for the Swissy, and that was green lighting short-term traders to be selling rallies in that market. Long term, however, we're still disciplined and just as focused as ever on potential support right here, which we feel historically could lead to a very interesting potential buy signal vis-a-vis a historic higher low. And we'll see that pretty clearly on the next chart, dollar index. Same pattern, dollar index, as we just saw in the dollar Swiss. The pattern on the daily is still bullish. We're very much interested in support in this area down to probably more or less 79.50. You can see the bottom of our zone, 79.64. So yeah, that's going to be definitely an interesting area on the chart. Support lines, by the way, should be drawn with a crayon, not a sharp pencil, because they're a band of support. You can certainly trade below them. What really we look for is they don't close below it. Okay, so definitely an area of support we're interested in. Longer term, yeah, this pattern is still bullish. Short term, however, we're still selling rallies. Yeah, we covered that last week, and again, you can see how that's working out. Every rally stops a little bit shorter than the previous one, and that creates that bearish pattern that's so important to us. And when we're big believers that the pattern on the chart absolutely is a reflection of underlying fundamentals in that market. So if you're seeing, if there's bearish news on the horizon, it's going to show up in the price pattern first. We like continuing to sell rallies short term. Back on the big picture though, however, here's a weekly chart, and you can see you're coming up on good support, potential support I should say, at that green line. Looks like you broke out, and then it's going to potentially come back and test that. So here's what we're looking at. I could show it to you on a daily chart here now. A potential higher low in this area. So we see a potential higher low, the market could turn around, then you're in a position to go up and make a higher high than 81 even, and then you're into a new bull phase in that market. And that's our big picture focus even though back to the very short-term intraday, we're currently selling rallies. But as I said, we're just as disciplined, just as focused, just as patient to see what the big picture gives us. And I think that's a huge edge as a trader. It really doesn't matter whether we're buying or selling. What matters is we're on the right side of the market. And you have to understand that the right side of the market long-term may be different than the right side of the market today. Short-term, definitely, very definitely different dimensions in time you have to trade as a trader if you're gonna hit that feed bell as much as you'd like to. If you're gonna trade every day, you better trade the lower time frames. Here's the euro, kind of a mirror image of the opposite image of the dollar. You found support. He had secondary support. You take that high, you take that low to that high. You stretch it down. No surprise. There's a predictable level there. And hell, it traded through it, but it couldn't close below it. Now it sets up the euro for a potential counter trend rally. There's nothing counter trend about that intraday. That's a pretty good rally, and we'll show you that. And this is why we hit we touched on our RTT ratio last week. You can see since then the short-term patterns continue to bull up here, continue to shift there. Your 25 days up. So if you're trading the 5 through 25, which I like to trade, or the 10 through 50, you highlight the 10 through 50. You take any three successive patterns, trade in the same direction as the majority of the patterns. So coming in this week, you definitely had the majority of patterns up if you trade that intermediate term trader 10 to 50-day pattern. So you were definitely buying dips, and you saw how that worked out for you today in the euro. Here I can even go to a short-term chart, and I'll show you a nice dip to buy here based on how we view things as far as how we paint a buy zone in an uptrend. And I'm just going to take that low to that high, and man, look at it, got right into that zone. And it's sure you can probe below that zone as long as you don't close below it a couple times. But here, that provided a nice dip to buy today, and that's something we were focused on today. Here I see a little better on the 3-minute chart. There you go. Beautiful buy zone in the euro this morning in the U.S. session, and you saw what happened next, right? Next market, the gold market. Gold had a pretty good hiccup on the FOMC meeting. You know what's interesting about that? You had that big run up in gold, and there was really no news. I mean, the FOMC, Madam Yellen or Chairman Yellen didn't say anything different. Really, there was nothing new there. But the market had a pretty good reaction to it, and the gold market jumped sharply. Basically, you ran shorts out of the gold market, and you put yourself right back into a longer-term sell zone. So that's where we're at with the gold. You know, short-term, similar to playing the euro, short-term on the long side. You know, if you want, as a day trader, you can focus on the long side in gold. But we don't day trade gold so much. That's a market, a longer term market. So we're more interested in this longer term sell zone you're in now, created from that high, that low. It's still a bearish formation. You take that high, that low, you've retraced less than 5/8, less than 2/3. So that's still a bearish pattern in our book. Last market will be dollar yen. We saw dollar yen. We saw weakness in the dollar yen in support of weakness in the dollar index and strength in the euro US dollar. So dollar yen faltered here. We were kind of keeping an eye on that 101.40 level. That gave way though. Once it gives way, you start getting successive closes below it on an hourly chart, then there's not much sense focusing on that level anymore. Support's giving way, and we're back to where we were realistically back in the late winter and throughout the spring. I'm a broken record. If I like it at 101, I love it at 100. So I love it at par. So you've got a really good support zone overall between 100 and par in the dollar index, and I think, in the dollar yen, and that's going to be our long-term focus right now. I'm going to leave you with some words of wisdom from my mentor, and boy, this is so true. I can't say it enough. The majority of thinking is detrimental to personal peace and profits in the market. You don't want to think. You want to have a sound methodology that can help you determine the direction on those different dimensions and just stick with the patterns. Do what the market tells you to do. Have faith that, well, believe me, the pattern on the chart is absolutely a reflection of underlying fundamentals. Okay, if there's a change in the underlying fundamentals, that's going to show up in the pattern on the chart right away. Thank you so much. My name is Jay Norris, and I teach trading at Trading University.